It's a Fed week, and all eyes will be on the results of the two-day meeting. Will the Fed raise rates, and what will it mean for gold? We have Frank Holmes joining us this Monday. Frank, good to see you.
It's good to be here. I'm in New York.
All right, Frank. Well, let's start by paying close attention to the gold market. We saw the metal move above 1,200 earlier this Monday morning. How is the metal set up here ahead of Wednesday's Fed announcement?
Yes, it's a trading pattern and just going sideways, waiting to see what happens with the U.S. versus Europe and Japan.
Now, Frank, demand has been lackluster for gold, and we do see choppy trading here for the metal. What price point do you see demand turning around and helping to move gold higher?
Well, I think demand from retail investors has been weak, and I think it from a lot of the swing hedge fund traders has been weak. But I do think from Asia, from India, it's going to be a double from last year, maybe a triple from this period last year. We're seeing China continue. We're seeing Russia expand. So central banks are expanding. So there's some real positive dynamics that are taking place.
All right, Frank, on that note, let's get to your opportunities and threats segment now. Starting with opportunities, you mentioned this in your morning commentary. China's aim to include the RMB in the IMF's special drawing rights basket to be reviewed next month. What could this mean for gold?
Well, to have that credibility in the capital markets, you have to have gold as a back to your currency. And I think that's even Putin's been doing with all his difficulties in the global scene, is still buying gold to support the ruble.
All right, Frank, sticking to opportunities, let's look at the Fed. Will they or won't they? We don't know what the Fed will do and what the adverse effects of the Fed rate hike will do to the global economy. So could this not be a positive for gold, especially in foreign currencies?
Here's the magic. The magic is real interest rates. What is the interest rate the government's charging minus the CPI number? So back in 1980, when gold hit 850, numbers were inflation was running at 12%, and interest rates are at 8%, not zero as they are today. So what you have to take a look at is what are the real rates of return. And right now, the U.S. has the highest real rates of return of the G7 countries. And I don't think that's going to change too much over the next 3 or 4 months.
All right, looking at threats now, this is the big headline in Venezuela's move with Citi, where they converted part of their gold reserves into a $1 billion in cash. Do you expect other central banks to follow suit?
Well, I think it could be that supply comes to the marketplace because they'll default on their currency, on their obligations. The Venezuelans, just history. And socialists, any country that's a socialist never really respects money, especially other people's money. So I just, it's a matter of time before they default, and that gold will be sold, and I think it'll be absorbed. It'd be very easy for the Chinese to come in to buy that whole block. It's a rounding error, but it's important for them to accumulate a big position of gold to back the renminbi as a credible global currency.
All right, let's wrap now. What's the touchdown pass this week?
I think you hit it at the beginning. We're looking for a Fed fund with what's going to happen with the Fed minutes coming Wednesday. There'll be some other economic data points which are important for a global economic activity, but it's the Fed minutes which are important because the last Fed minutes, they had not included a lot of weak economic data points. One of the concerns that we're seeing is the deterioration of the quality of debt credit. So that would be very dangerous to raise interest rates. That could create an unfolding economy.
Thanks so much for joining us, Frank. We'll see you next week.
You're welcome. Happy investing.